Hey guys, I'm your host Rashida Punawala, and welcome back to another episode of GSB Insights, a podcast where we dive into the stories of leaders and innovators in business, finance, and marketing. GSB Insights is all about giving young professionals an insider's view of the business world, global economy, and geopolitics, so you can learn, grow, and stay ahead in today's fast-paced market. Today's episode is an especially exciting one because we are sitting down with someone whose career sits right at the intersection of traditional finance and the rapid evolving world of Web3. We have Olivia Vande Woude, currently working in business development focused on tokenization at Ava Labs. Prior to that, she spent over 4 years at T. Rowe Price as an associate analyst, building a strong foundation in equity, research, and traditional asset management. She is also a Web3 scholar with TradFi, where she has been deeply engaged in the blockchain and crypto ecosystem. In today's conversation, we explore her transition from Wall Street to Web3, break down what tokenization actually means for the future of finance, and discuss how young professionals can position themselves at the forefront of this next wave of innovation. So first off, I want to thank you so much, Olivia, for coming on GSB Insights and being here with us today.
Thank you so much for having me. I'm thrilled to be here. And I just want to start off by saying, what you're building with GSB Insights is really the precise kind of resource that will help so many students find their footing and really figure out where they want to go from a career perspective. And I had a chance to review some of your recent episodes, and hearing Anthony Scaramucci break down crypto and agentic AI and Fed policy in real time, or, Tracy Castle-Newman unpack her decades worth of experience from navigating Wall Street. That's the caliber of insights that I think really will help, sharpen any student's career vision, and even before they land their first role. So you're putting Gabelli students and others in the room with the people they need to learn from. So keep it up.
Thank you so much. So first off, can you just kind of walk us through your career journey and what initially drew you to crypto and blockchain, especially with your path leading to Ava Labs?
Yeah, absolutely. I think like so many others, the path really was not linear. But my career started in traditional finance. I was an associate analyst at T. Rowe Price, focused on small and mid-cap bank stocks. And that was really immersive, analytical work. I was living inside of balance sheets, stress testing, interest rate sensitivity, and tracing the anatomy, if you will, of credit cycles. And I really loved the rigor of it. But I also participated in their digital assets working group led up by Blue Macellari, who's amazing. And that was really where the disruption started happening in my thinking, and where I started considering full-time roles, on the proverbial ground, with boots on the proverbial ground in digital assets. I'd say what initially drew me to crypto is that, Bitcoin really broke something open for me. I read, per the suggestion of a friend, Chris Berniski's Crypto Assets book, and the scarcity thesis really hit me with an intellectual force. I think the idea of, or at least I thought the idea at the time, of a mathematically enforced, fixed supply in a world of boundless, unpredictable monetary expansion was really a challenge to everything at that point in my undergrad career that I thought I knew about money and value. And so from there, I just started building my toolbox, if you will. I did TradFi to build more technical fluency and learn more about the actual mechanics of how blockchains function, was reading white papers and, any primary source I could get my hands on. And the deeper I went, really the clearer it became that this was going to be the fundamental, really reimagining of how capital markets could be architected. And that really excited me. And I think, the move to Ava Labs specifically felt almost inevitable. For those who don't know, Ava Labs is supporting the growth and adoption of the Avalanche blockchain network. And I was really looking for the place where the two worlds of both finance and, crypto were colliding, and with the most force. And at that point, Avalanche was already drawing in really serious institutional gravity, and that Franklin Templeton, BlackRock, Citi with their testnet layer 1 blockchain were in deployment. And I really saw an exciting opportunity on the distribution side too, of where, we could get tokenized assets out of issuance and into the hands of fintechs and allocators and platforms that could actually deploy them. And so I'd say for anyone who's listening to this, especially students, 2 lessons that I'd offer anyone early in their career, and I consider myself to be early in my career too. So I say this with a high degree of humility, but first off, like, volunteer for the thing that nobody fully understands yet. Like, I think that's where you can often find the most white space. For me, the digital assets working group at T. Rowe, like, wasn't my core job, wasn't on my performance review. But for me, it was really an intellectually alive, thing happening around me. And so I leaned in. And I'd say that, one decision really completely redirected my trajectory. And I don't mean to sound like a fortune cookie, but, opportunity rarely presents itself, cleanly. And sometimes it literally looks like going to a meeting, you almost didn't take. And then the second lesson that I'd offer too on this career question is, like, your previous chapter is never wasted. There's an old phrase that goes like, no great thing is created suddenly. And I truly believe that every season of work is really building on the next one. And so I brought my experience from T. Rowe Price with me to Ava Labs, my fluency in bank balance sheets and credit structures and more institutional decision making is really what has enabled me to walk into a room now with a BlackRock or a Franklin Templeton of the world and speak their language. And so that pivot was, a compounding of multiple experiences. So whatever you're building right now, even if it feels really disconnected from where you think you want to go or where you end up going, you'll find the thread. It's in there somewhere.
Yeah, no, I think that's really good advice. And, like, also the fact that you kind of had to put yourself in, like, take whatever opportunity kind of comes to you and just, like, kind of run at it because you really don't know, like, what door that's going to, like, open up and, like, lead to.
Yeah, absolutely. And sometimes, sometimes you walk into a room and, perhaps you realize that that's not the avenue for you too. And that's an answer in and of itself. And so I would encourage, especially undergrads that have, access to various courses and various extracurriculars and clubs. Like I did Women in Business, for example, as well as the Investment Club at William & Mary. And those, exposed me to topics and, alums and people who I otherwise would not have had access to. And so I would definitely encourage, anyone who's listening, especially students, to, put themselves in the room where perhaps you don't feel that you belong in, or that may, be daunting at first because you think that the folks there have a knowledge level, much greater than yours. And perhaps that's true, but take that opportunity to learn from them.
Yeah. No, and again, I think it's super important to just kind of always keep learning and be, like, open to learning new things. Because you really never will know it all, so.
Absolutely.
So my next question is, could you kind of, like, explain for people who aren't that well-versed, like, what is the difference between, like, TradFi and, like, traditional finance versus what you're doing now with crypto, blockchain, and this whole digital asset space?
Yeah, absolutely. So I would say the skills travel better than many would think. I know that in my case, fundamental analysis, capital markets, fluency, the risk-adjusted return frameworks that I learned at T. Rowe and in my CFA studies, all of it applies. And I'd say specifically on my team, many of us at Ava Labs came from exactly that background of Wall Street, asset management, trading desks. We have quite a contingent of ex-Citi folks. We didn't really leave that institutional DNA, if you will, behind, but really, brought it with us and pointed it at a different set of problems is what I would say. What does change, of course, is the environment. Some of the instruments are newer, especially in DeFi. Regulatory frameworks like the Genius Act, Clarity, are still taking shape. But really, at the end of the day, the rules of traditional finance still apply. How an institution will evaluate counterparty risk, how capital structures may get stress tested, like distribution economics that determine, if a product can in fact scale. That knowledge doesn't become any less relevant in crypto. In fact, it's probably even more relevant. It just becomes more valuable because a lot of, several people, I would say, don't necessarily have that experience if they have just a technology focused background. And so that's really the edge, is like walking into conversations with institutions and speaking their language more fluently, but also while understanding the underlying infrastructure that's, sitting underneath of a trade. And so, all that's to say, what ties it all together for me is really rigor. Like, you have to have the ability to underwrite a business model, stress test a thesis, like ask tough questions that really separate the more durable capital market infrastructure from, hype cycle driven narratives. And that discipline, I'd say, travels very well across both of these worlds.
Yeah. I think that's very true. Like, a lot of these skills kind of are still a little transferable because I would like to think in theory, so dealing with kind of like the same things within like the markets and just like evaluating like risk and all these things with crypto, which falls into my next question, which is for someone who like maybe has no idea what this space is. Can you kind of explain like what a blockchain is and just digital currencies too?
Yeah, absolutely. And also happy to delve into, what makes Avalanche specifically different. But I'd say, like, let's just first step back and ask a more, fundamental question, like, why does any of this matter to a business in the first place? So I'd say, like, let's just think about what the traditional financial system actually requires to move money. It's days worth of settlement. It's like armies of back office staff that are reconciling records because each institution maintains its own version of reality. Cross-border payments, bleed value at every intermediary handoff. Yield-bearing instruments are, often locked behind geography or minimum investment thresholds and distribution relationships that literally took decades to build. And so that's how the system works today. It's really expensive, and most of that cost is really invisible because it's been baked in for so long and nobody questions it anymore. So enter blockchain. A blockchain can replace much of that friction with a single shared ledger. And that's one version of truth that every counterparty can read from and write to simultaneously, and without a central intermediary manufacturing trust at every step, as I mentioned, is what occurs in traditional finance. Tokenization takes that a step further in that you're representing a treasury bill, a share of a fund, a piece of real estate, whatever it may be, as a digital token on that ledger, and the ownership becomes programmable. So you transfer the token, you transfer the asset instantly across any geography, at some point, any hour potentially, without asking permission from a clearinghouse, a correspondent bank, or a back office team that's working on a 2-day settlement cycle, if not more. So I'd say the business outcomes here of blockchain are pretty concrete and measurable in that you can see settlement compress from days to seconds. So capital stops, dwindling, sitting idle, waiting for trades to clear. You see reconciliation get automated through smart contracts. So you have operational costs and headcounts, that compress with it. You see distribution that reaches investor bases that the traditional intermediary stack was really never architected to serve. And then you also see, the access to instruments that were previously available only to the largest institutions in the world. And that opens up, in my view, to an entirely new universe of distribution platforms like fintechs, specifically neobanks or wealth tech platforms, exchanges, allocators. And so you see, to summarize it, the cost of moving, managing, and really accessing capital at scale drop. And when that cost curve shifts, in my opinion, the addressable market explodes. So it's a very, very exciting, very exciting time. I'd say also, I think a lot of the headlines can be a bit confusing in that we hear about crypto being conflated with meme coins and, collectibles, which are interesting, but I'd say a lot more speculative asset classes. And the fact of the matter is the underlying technology is quite boring, but very exciting to institutions that, like I mentioned earlier, have been requiring days of settlement, armies of back office staff, and just, layers of intermediaries and costs to operate.
Yeah, no, I think it's a really interesting, new technology that is coming to the forefront of, finance. And I feel like it's kind of, the same as, any, technology that we saw in the past, like with the internet or even like the iPhone. Like everyone at first was kind of like unsure about how this would like progress and how this would kind of impact society, but nonetheless, for most of it has been for the better. So I'm excited to see like also, as this is still like kind of in the early stages, the Genius Act being passed, Clarity Act, just to kind of see how this like kind of evolves and gets into something a little bit bigger in the next few years.
Yeah, absolutely. And we're only going to see more guidance and rulemaking from OCC, FDIC, SEC has been very vocal. So it's really an exciting time to be in such a nascent space. And I don't, like I just mentioned the why of blockchain, but, not all blockchain networks are created equal. And I can talk more about, from my vantage point, just sitting in the Avalanche seat, most blockchains are built around a single blockchain thesis, which is the idea that everything flows through one pipe. So stable coins, equities, bonds, meme coins, all of it share the same infrastructure, rules, and potentially congestion. And so as, you alluded to Genius and Clarity and these emerging, regulatory frameworks, as those take shape, I'd say that Avalanche really offers the ability to, customize accordingly and reject the single chain thesis that I just mentioned. So it allows anyone, be it an institution, a government, a fintech, a startup, to deploy their own purpose-built blockchain that's customized to their own specific business needs, compliance requirements, regulatory demands, and jurisdiction, and so on. And so these chains can run in parallel, but also interoperate if they so choose. So you'll see, digital dollars that can move from one chain to buy equities on another or trade commodities on a third. And I'd say the architecture is really designed for a world where financial infrastructure is more modular as opposed to monolithic. And from a more, the practical logic perspective, it's pretty straightforward. We're seeing FIFA, for example, launching a layer 1 blockchain on Avalanche. They're not going to deploy alongside meme coins. They decided they needed their own chain with their own economy for things like collectibles or ticketing or payments and loyalty programs, operating entirely under their own rules. And that, same logic applies to serious institutional issuers. Like Canary, for example, they're bringing tokenized equities on chain with actual custody and broker-dealer infrastructure. And then if you're an Apollo or a BlackRock or Franklin Templeton, they have all brought their assets live and onto the Avalanche ecosystem. You can also just launch those on a public permissionless chain without all of the considerations of of a government or where you need a purpose-built blockchain for meeting specific business needs or compliance requirements. So there's really more flexibility in the Avalanche ecosystem. These are all live products with, real capital behind them, and, choosing Avalanche. These institutions are choosing Avalanche because the infrastructure was really built to meet their requirements, as opposed to, ask them to compromise as they would have to with a single chain general purpose world.
Those are all really interesting things that Avalanche is doing, which kind of moves into my next question, which you kind of touched on already. But if you want to kind of dive in a little deeper, but from your perspective, what differentiates Avalanche ecosystems from other layer 1 blockchains, both technically and from the business standpoint?
Yeah, absolutely. And I touched on this, but I'd say the longer term bet here is that, in 10, 20 years time, blockchains will really be the rails for value transfer, and similar to the way the internet became the rails for information transfer. And there won't be one chain, there'll be thousands, each that are purpose-built for their own use cases. And Avalanche is really positioning as the infrastructure layer that makes that proliferation possible, with sub-second finality, with really inexpensive transaction fees, and, importantly also with the integrations and what I call tech enablement partners that enable for fintechs, allocators, institutions to access products and more efficient products and services, and in a one-click fashion with Avalanche. And that's more than a tech story, right? Like that's more of a market structure thesis, in my opinion, and that, the institutional adoption we're seeing today is really just such early evidence, that it's playing out exactly as designed.
So where do you currently see the most meaningful institutional adoption of blockchain technology, and like what barriers are still preventing like a broader adoption of crypto?
Yeah, great question. I love this question. I'd say the most meaningful institutional adoption happening right now is at the distribution layer, and it's really chronically underreported story, in my opinion. I think the question in tokenization has really moved past whether institutions can, technologically issue assets on chain. We've seen BlackRock, Franklin Templeton, Apollo, KKR issue assets on chain. They've already really answered that question. The harder problem is distribution, right? So how do you get those assets into the hands of investors, fintechs, and platforms that can actually put them to work? And one example that I point to is with a company called OnTop. OnTop is a global payroll platform, and they are powering teams across 150 countries. They processed, I think, over $1 billion in payroll for more than 60,000 workers last year. And they've been partnering with another company called OpenTrade, and they launched the Future Fund and embedded directly inside the OnTop global account so that basically workers can automatically earn on their USD balances while maintaining full liquidity. So this is the same account where they receive their paycheck, where they hold their savings, their spend, and their transfer funds globally. There's no separate wallet or even really a behavioral change, right? And they built this in under a month with OpenTrade, and really what the worker now experiences a paycheck that grows. And so OpenTrade and their numbers are really telling us and the market like how fast this model is scaling. They've garnered over 25 fintech partnerships. They work with Buenbit to offer 4 million users across LATAM, access to 7% APR products. Credite is an Africa-based fintech. They're delivering 2 to 9% yield to 500,000 users across Africa. And so these are live products with, again, real users. And I'm really excited to see OpenTrade continuing to embed into fintechs such as neobanks, wealth tech platforms, exchanges, again, like existing distribution channels, and offer access to products and services that perhaps we may take, for granted in the US, but which are actually quite hard to access outside of the US. These are things like access to USD savings accounts, investment products, and so on. And then to answer your question, I don't want to miss this on the barriers question. I'd say that the barriers that historically have impeded adoption remain and are real, but they're falling away, right? Like, so custody was the first wall, and it's coming down, fast. The Anchorages of the world, the Coinbase Institutionals, Fidelities, like the infrastructure for custody and more is maturing. I'd say investment policy mandates are another are the second wall I view. Like most institutional mandates have classified digital assets as outside of permissible categories, and changing that, of course, requires layers of approvals, from board approval to legal review to really just the organizational will to do it. It moves slowly, but it's moving. And then I'd say, and you alluded to this earlier, the third wall that I think is coming down is on the regulatory clarity side. Obviously, the Genius Act passing was a major milestone. I think the rescission of SAB 121, has expanded bank custody rules and is really finally giving institutions the legal footing that they've been waiting for. Interestingly, Coinbase and EY Parthenon, I believe, did a 2026 survey, and they found that I think it was about 75 or maybe it was 70% of institutions are planning to increase their digital asset allocations this year. So the conviction is there. The walls are coming down, and really the pace is accelerating, and I'm excited.
No, I think this is a very exciting time, especially in like finance, to kind of see what's happening with these currencies and to see how this kind of progresses. Also, on the bank side, where do you see like banks going with kind of starting to release their own like versions of like a stable coin? Like I know JP Morgan has their like JPM coin that they're working on. So how do you see like digital assets like impacting banks and that whole side?
Yeah, I'd say first of all, I think it's still early innings. We've done some work with banks on, privacy solutions, as that's a big, question du jour of how do you, issue funds on a transparent, public permissionless chain, without, causing a run on those funds. We've done work with Citi more specifically on, on-chain FX pricing and execution. So there's a lot that banks are working on in terms of using and harnessing blockchain technology on the back end to make their processes more efficient. I'd say with respect to the tokenized deposits versus stable coins debate, I think it's a pretty big debate that's been happening in institutional finance, and I think ultimately the outcome will determine how the next generation of payments infrastructure gets built. I think the distinction matters more than some people may appreciate. Stablecoin is a liability of the issuer. So say Circle or Tether, a bank, whomever it may be, that's redeemable for fiat at par. It can live on a public chain. It, can be permissionless, and it can, of course, move at the speed of blockchain, if you will. A tokenized deposit, in contrast, is different in terms of its legal structure. So, and architecture. It's a direct claim on a bank, right? So it's subject to deposit insurance, reserve requirements, the full, regulatory apparatus that really governs traditional banking. So it doesn't leave the banking system. In my view, it just represents, a bank balance on a blockchain rail. And so I think banks love tokenized deposits for that reason. They get to keep the customer relationship, they keep the regulatory perimeter, but they also get the settlement efficiency of blockchain technology, right? And without, necessarily giving up ground to non-bank stablecoin issuers. So I think, like, to your point, JP Morgan's JPM coin is a pretty clear example of that thesis, and that there's a tokenized deposit that's moving between, institutional counterparties and settling, transactions that used to take days and seconds. So it'll be interesting. I think like the answer is that both will coexist. They'll serve different markets, right? Like tokenized deposits will probably dominate more wholesale institutional settlements. So think larger interbank flows or securities settlement or corporate treasury management, where you have counterparties that are regulated, you have really large amounts being transferred, and also the regulatory parameters, matter significantly. And I'd say perhaps, stable coins will dominate more on the distribution layer, that is cross-border payments or embedded finance or more consumer-facing yield products where, speed, accessibility, and composability may matter more than staying in the banking, banking system.
I agree, and I think it's going to be interesting to see, especially how like banks start to adopt digital assets that into their system. And I just think it's a very exciting time period where we will see like what happens a lot with the use of these digital assets, stable coins, and blockchains. So
yeah, and I was just going to say too, like, stable coins are already the most adopted like blockchain product in history. They've found really strong product market fit. It's not speculative. They're really solving a true problem at the distribution layer. They move across borders. They can settle instantly. They're accessible to fintechs and neobanks that, perhaps might not have as an easy of a path to a direct banking relationship with a U.S. bank. And I think the Genius Act 2 working its way through is it's designed to create a federal framework for, stablecoin issuance. And it really signals that regulators are, increasingly treating stablecoins as a legitimate piece of monetary infrastructure as opposed to a threat to it. So I'm excited.
And also, I think that's a lot of people's issues with like stablecoins or crypto. Why people are hesitant because of like the speculation aspect of it, and wondering if it really is like a tangible thing to have. Which again, I guess like if you look at like prediction markets and all that is based on like a crypto speculation, which I guess puts people in more of like a hesitant view when it comes to like cryptocurrencies and that. Which, do you mind speaking to a little bit, if you can, a little bit about like prediction markets and crypto and the entire speculation around that?
Honestly, you should have our licensed gaming business development lead on, Greg. That is his bread and butter. But I can talk more about what's exciting on the tokenized asset side, and like where I do think there's going to, be more of a disruption in finance. And I think like as we're talking about innovation, like you alluded to prediction markets, I think the history of financial innovation is really a history of distribution breakthroughs. You could see, prediction markets as one of those, but I look back, historically, like ETFs didn't create, new asset classes necessarily. They made, the existing ones more accessible at scale to a broader investor base and really at a fraction of the costs. I'd argue tokenization is really the next version of that thesis, and that it's moving faster. It's compressing the cost of distributing yield-bearing instruments across geographies and platforms and investor profiles that really the traditional intermediary stack was never really designed to serve. And so I think like if you look at, examples like this crop of financial wellness platforms that are emerging, for example, one of them is Glim. Glim is a Colombia-based financial wellness platform. They help employers offer payroll benefits. And so employees can collect salaries in various currencies. They can save in dollars. They can earn yields. They can access a debit card, like all in one place. And they are processing payroll for over 10,000 employees across 100 companies. So they're doing very well. They partnered again with OpenTrade, which I mentioned earlier, is a yields as a service platform, again, that happens to be powered by blockchain just because it's more efficient. But they can now offer workers, yield on their USD balances automatically without, additional steps or accounts or frictions. And I'd say like, especially in, various jurisdictions in LATAM, there's a lot of macro factors that make it a place conducive to these kinds of blockchain enabled products that, again, are products and services that have product market fit because they serve a need, not because they're on blockchain rails. And so in Colombia, where Glim is focused, like inflation and currency volatility are daily realities, and, lived experiences that really can erode purchasing power. And, thus workers have wanted to save in dollars. And so the issue historically has been that dollar denominated yield products were inaccessible or really prohibitively complex, or maybe a combination of both. And, traditional banks and investment channels made it quite costly and onerous for a fintech that's existing outside of the U.S. to really offer anything substantial. And so, workers could potentially save in dollars, but those savings were really sitting idle. And so I'm excited, like from an innovation perspective, that OpenTrade has addressed that issue in a, single API-based integration. Their yield infrastructure converts idle payroll balances into, yield-generating USD assets that are backed by high-quality U.S. financial instruments, fully liquid, fully compliant, and also, invisible to the end user, who of course has access to that information and through disclosures and fine print, but doesn't need to really know or care that blockchain's on the back end. So Glim's work, the worker bases that Glim plugs into, they don't, move funds or open new accounts or interact with anything that's crypto adjacent. They just have, yield just appears. And so that's really the disruption that excites me most, is seeing a product like this, helping workers protect their earnings against inflation and devaluation, and really embed long-term financial security into the employee experience. And really, at the end of the day, again, it's a product or service offered with blockchain abstracted away. It's a paycheck that works harder for someone who never had access to that before, powered by infrastructure that, again, is running completely out of sight.
No, I agree, and I think the tokenization of real world assets are something that is very prevalent and very exciting to see in the next few years, and as it's starting to slowly already take place. What are the biggest challenges in onboarding traditional users and institutions into Web3, and how is Ava Labs approaching that problem?
Yeah, definitely. Great question. I'd say the institutions, moving into Web3 are not doing it because, of a white paper necessarily, or a really, compelling keynote that they saw about the theoretical future of finance. Like, at the end of the day, they're doing it because someone showed them a better P&L. And that's, I think, a lesson that this industry has taken a long time to learn. For Ava Labs, it's really the lens through which we approach most of our initiatives. I'll start with your first question on the challenges piece. So, I'd say 3 barriers have historically blocked institutional participation. One is operational friction. Second is compliance infrastructure. And then 3, I think, tangible business outcomes. And I'd argue, many of these have to be solved simultaneously. Like, we really have to solve 2 out of the 3. Otherwise, a deal doesn't close. And you really have to have all 3 land before an institution's investment committee and their legal team and their treasury desk will all say yes. And so the way that we approach it at Ava Labs is by building infrastructure that makes the blockchain completely invisible and really leads entirely with the business case. So one example is our partner Axiom. It's spelled AXIYM, but they're a regulated Swiss financial infrastructure provider, solving one of what I view to be the biggest inefficiencies in global payments, which is pre-funding. So today, money service businesses are required to hold cash that's sitting idle across dozens of jurisdictions in advance, just in case a payment needs to happen there. And that's really dead capital that creates drag and FX exposure, among other things. But Axiom's eliminating that. So they're acting as a real-time liquidity engine that allows for payments to execute and also settle on demand across 140 currencies, with Avalanche, handling settlement on the back end. So in practice, what that looks like is that payment companies keep operating through the banking APIs and treasury systems they already use. They don't have a formal blockchain integration. There's no operational restructuring, and the outcomes can thus land more immediately. So there's less pre-funding, there's faster settlement, better capital rotation, and all while having the compliance infrastructure of sanction screening, transaction monitoring, etc., being built into the foundation from day one, as opposed to just tagged onto it afterward. And I think the same principle can apply to the consumer layer, right? Like I talked earlier about Open Trade. They're routing stablecoin deposits into real world assets and allowing access to yield back to end users. So that's embedded directly inside the fintech and neobank products that people already use. So workers in Colombia, Turkey, Nigeria, etc., they can earn yield on their paychecks automatically, for example, again, powered by infrastructure that's operating completely out of sight. So I'd say the approach that we have taken is really making the infrastructure invisible, and the business outcomes quite tangible and quantifiable. Because if you get that combination correct, in my view, the institutional onboarding really becomes less of a sales problem, and the demand really takes care of itself, because again, these institutions, enterprises, etc., can really see a compelling reason to use blockchain on that back end.
My next question is, what technical or non-technical skills do you think will be most valuable for students entering finance or blockchain in the next 5 to 10 years?
I love this question. For full transparency, I double majored in history and French. And so, and I took a lot of business school classes as well, but I come from probably the most liberal arts, background that you can find. So, obviously that took an amalgamation of technical and non-technical skills, to enter this space. But, I would say, obviously, coding can be important. It depends on the avenue or the path that you want to forge for yourself. But I'd say, coding is important. Financial modeling can be important. But really the skill that I find to be of utmost importance is translation. And that is being able to, walk into a room of traditional asset managers and make on-chain settlement sound inevitable. And then turn around and walk into a room of crypto builders, and educate them more on how institutional custody requirements are in fact quite reasonable. And so that translation skill, in my experience, is pretty tough to find in the industry right now, and it really compounds far beyond what anyone I think thinks is important. I'd say on the technical side, just to be more practical about this, on the technical side, you don't necessarily need to build the infrastructure, but you do need to be able to read it and look at it deeply enough to know, what a tokenized credit structure looks like, for example, and ask questions that really matter. Where does the risk live at redemption? Who's the counterparty when the structure gets tested at 2 a.m.? Those kinds of questions. And that, on-chain fluency fused with, financial fundamentals is a combination that I think is pretty rare. Though I'm excited to see more traditional finance folks enter the space, along with technologists. And so it's a really interesting place to be in, that you get to work with a variety of colleagues, from technologists to those with a financial background to regulators, and really crack the code, pun intended, on what blockchain implementation at scale in traditional finance looks like. I'd say a really good example of this, especially for those that are exploring, job opportunities in the space, is Valinor. They are one of our partners in the Avalanche ecosystem. They just closed a $25 million seed round, and really built on this thesis that I was just talking about, of marrying really rigorous credit underwriting with digitally native operations to originate institutional credit on chain. They were founded by two Blackstone credit veterans, and what they're really building is a credit story that's operating on just better infrastructure. And the analysts who can read that deal, who hold the capital structure and the settlement layer in their minds really simultaneously, are really those that are architecting the next generation of credit markets. And then I'd also say beyond, the technical side, as well as the financial, savviness side, is really regulatory literacy too. I don't think that's a discipline that, is getting as much in terms of headlines at undergrad programs, but it's really where, consequential leverage lives, right? MiCA in the EU, or the SEC custody framework, or, the parallel regulatory regimes that are being created across LATAM and APAC. Understanding why those rules are written the way they are is really what enables you to see where, institutional capital will flow before it moves. And I think it's a really, powerful tool and skill set to have as well. And, the students who are entering the space now, you don't necessarily have to pick the right blockchain architecture or the right asset class. But really, I would focus on earning credibility across the worlds that I just mentioned, and becoming the person that, all sides of the table, be it regulators or technologists or those in TradFi, call when they need that gap closed. And so I think it's a really exciting time to join the space. Finance is really being upgraded at the infrastructure layer, and If you're a student who's fluent in all the regulatory, the technical, the finance languages, those are the students that can be best positioned to help execute that upgrade.
And then my final question is, do you have any advice for any of our students? You kind of gave us so much great advice already, but anything else to kind of leave our listeners with as they are thinking about entering the finance space, either in TradFi or crypto?
Yeah, great question. I'd say my 9th grade geometry teacher told me many paths lead to the mountaintop. So there's not one size fits all, but I'll argue the most important step is developing a point of view. So read the primary sources, read the Bitcoin white paper, the Genius Act, the MiCA regulation, the SEC statements on custody. You don't need to memorize them, but it's really the people who shape this industry are the ones that really went back to first principles and formed a conviction. And that intellectual foundation is really what separates someone who kind of follows the conversation from someone who's really driving forth the conversation. And like I said, get on chain, again, not to speculate necessarily, but just to feel it, what it means to bridge assets that you may be reading about in a given white paper, maybe tinker with a DeFi protocol, to figure out what it means to interact with a smart contract directly. There's a slew of educational resources that I'd recommend. I did SheFi, for example, as I mentioned earlier. That's kind of like the MBA of Web3, as they're calling it. To check out, I think Wharton and some others have some Coursera courses, but there's also just a swath of information on X and, other, Telegram chats. There's Web3 jobs. There's several Web3 jobs, Telegram chats to take a look at. But I think the experience of moving value, of watching a transaction settle in seconds, looking at your, transaction process through Etherscan, that really rewires how you think about financial infrastructure in a way that, no blog post or classroom ever will. And the abstractions really start to dissolve. And I'd say that ground level fluency will help you in any conversation or interview or deal that you may end up working on. And then really find the intersection of your existing expertise and interests and this technology, and then go deep there. So if you study credit, devour any bit of information you can find on a tokenized private credit deal. Look at Valinor's thesis, for example. Intane is another company that's in the asset-backed finance space. Look at what they're doing with FIS. Read through the Apollo Diversified Credit or ACRED filing. If you study payments, or if you're interested in payments, go understand how stablecoin rails are being embedded into payroll and remittance platforms right now. I think that it's good to some extent to be a generalist, but also hone in on an area of interest where, your domain and technology, this technology can really collide and really plant your flag there, if you will, early. And then, the other thing I'd say is show up in the rooms where this is actually happening, especially depending on the city that you're going to school in. Look up crypto events on Luma. Join, a Discord server or a Telegram chat, where, like mentioned earlier, Web3 teams may post jobs or share research and debate ideas in real time. This industry is remarkably accessible to those, who show up with intellectual curiosity and are eager to learn. And a surprising amount of it is happening in public and fortunately in channels that anyone can walk into. And then one final point I'll make, and I guess perhaps this is specific to me, but I process information by writing. So perhaps that may be applying to anyone who's listening too. Write about what you're learning. I think really the act of articulating it publicly, especially, be it on X or maybe you create a Substack, that really forces you to clarify your thoughts. You can start building credibility and get on the radar of the people who are already building. I think this ecosystem really rewards curiosity, and start there, and then the opportunities will find you.
Yeah, well, those are all really great pieces of advice, especially to just be able to get any hands-on experience or to learn as much as you can about whatever field or space you're going into. I think is, again, super important. But yeah, those are all the questions I have. Thank you again so much for coming on GSB Insights and just for sharing. Yeah, thank you.
Yeah, thank you so much for having me. It was really a pleasure. You asked really insightful questions, and I'm so excited to see the additional guests you'll have on GSB Insights. I think this is an incredible resource for students, again, that are finding their footing from a career perspective. So keep it up.
Thank you. Well, that's all I have for you guys today. Thank you for tuning into GSB Insights. Until next time, continue to learn, grow, and gain insight. I'm your host, Rashida Punwala, signing off. Well, that's all I have for you guys today. Thank you for tuning into GSB Insights. Until next time, continue to learn, grow, and gain insight. I'm your host, Rashida Punwala, signing off.